This is the economic update for Vantage Advisory. Today I'll talk to you about what's going on in the world and how that'll affect investments both here and internationally. My name is Ron Kacharski. I'm a licensed investment advisor based in St Kilda Road, Melbourne. What I'd like you to do is to watch closely in the next few minutes in this video, because I believe it'll give you some valuable clues on where you need to invest and where the opportunities are to make money in the next phase ahead. Because 2010 will be an interesting year. It'll be a year really of two halves. The first half of the year, the media was full of stories about an economic recovery, but also now that story is changing. So we'll see the second half of the year of stories of the world recovery slowing down, the USA losing momentum, and the recovery really not being a rebound. But just let me point out something that's very important here. What you hear in the next few minutes is not what you'll read in the papers. The mass media don't report this, and even the head of the ABC, who previously was head of the stock exchange, within recent weeks reported that the media is conning the public and conning investors. And their job is to keep the music playing for the people who make money out of investing, the big institutions. So just keep an open mind, have a listen for the next few minutes, but certainly it's not what you'll see in the daily newspapers. Before we look at important clues to where to invest, let's look back in history at the second greatest economy in the world, the most industrialised Asian country of Japan. Its stock market zoomed in the 80s, it peaked in 1990, and the Nikkei, their index, finished just under 39,000, and today it laments below 10,000. So the traditional buy and hold strategy in Japan has been a disaster for 20 years, and people's worth would be a quarter of what it was back then. Now this is a really important lesson for what's ahead for America, for Europe and UK, because we've had this massive expansion of credit. It started with people called the baby boomers, who around 1980 were buying homes to house their children and to marry, and we've seen banks and credit expand dramatically over the last 25 years. Now that came to a vicious end October 07 when the GFC hit, and the global financial crisis was the end of that era. The governments haven't sorted out the problem, they've just moved the debts from private to their balance sheets, and we've had a massive rebound in the stock markets. The next phase will be the new era where we see the world reduce or remove credit, banks get tougher on lending, and that's called deleveraging of debt. So the debt super cycle is over, and this is vital why investors need to change their investment philosophy. Just imagine if you'd had a portfolio of shares in Japan in 1990, and you held them for 20 years and it's worth a quarter of what you started with. This is not going to work here, and it certainly didn't work for Japan. So if you accept that we're in a new financial era where banks will become more prudent with lending, where they'll be reducing their exposure to certain assets, and the world generally will be reducing or deleveraging the amount of credit, then how do you as an investor make money in the next phase moving forward? There are a couple of simple rules that you need to follow. Now these are not textbook financial planning rules, and these are not the rules you'll hear from financial planners that work for banks and institutions. These are the rules that more independently minded people have always followed. Now the key in the next phase is to move from those growth assets that have done extremely well in the rebound, and they're things like shares locally and internationally, Aussie shares and international, and global property. They've rebounded through the money printing of governments. Now it's really, really important to move to what's called defensive assets, and defensive assets can make money in the next phase of this deleveraging of credit. Now the most defensive asset is cash, but you can't be in cash for the next 20 years. That won't achieve most people's goals. What you need is a high level of cash, a high level of liquidity, and very safe and secure investments that will grow in the next phase. Let me go through some of those because they are very important. And if at the end of the video you'd like more information, pop Vantage Advisory an email and we'll send you a list. Now, the areas that you really need to focus on are things like precious metals, gold, silver, platinum. You need to focus on to commodities. Now, what's built China and Asia are copper, iron ore and coal. They're referred to as hard commodities. So again, if you're moving away from more risky assets in the stock market, very good time to talk to our advisor on equities, Paul Tosin, and he will reassess every share, which to keep, which to change, which to add. So it's not get rid of all stocks, it's sort out the right ones from the wrong ones in the next phase. The next thing you need to do is look at agriculture, because after you've built the cities and affluence and wealth increases, people's eating habits change. Only this week you've heard BHP offering to buy the biggest fertiliser company in the world that mines for potash. And why are they doing that? They want to plan for the next phase, which is the food cycle that follows the building of those cities and countries. So there'll be great opportunities in agriculture, both in water, in wheat, corn, sugar, and other soft commodities. In agricultural land, right now we're seeing countries from the Middle East, Korea, Singapore, and other parts of the world wanting to buy Aussie farms because they're cheap. So I've got a very simple rule. Try to find assets that are cheap. Try to avoid investing into assets that are expensive. So beyond agriculture, we see opportunities in other commodities, in currencies, in property, based in particular parts of the Australian economy, and that's not residential. So we have talked about problems in the world, as I call it, ticking time bombs, and there are many of those in the developed world. It was only this week that America announced an annual deficit of $1.7 trillion, US dollars. Now that means for every dollar of income and taxes they receive, they're currently spending $1.60. Now you don't even need to be, or even a 10-year-old will tell you that you can't fix a debt problem by borrowing more money, nor could you fix a heroin addiction by giving them more heroin. So the world has been living beyond its means, and it's been predominantly done by debt, by borrowing off the emerging economies like China to sustain really consumption and lifestyle. Now that's not sustainable, is it? So let's look at a summary of what to do in the next phase forward. There are some obstacles, we understand that, but there are opportunities. So let's just focus again on the opportunities. And I think the biggest opportunity beyond what I've discussed is the emerging economies of Asia. So to invest into China, into India, and to parts of Asia. Countries like Korea, Taiwan, Vietnam, they're booming. And they'll grow at a faster rate than the rest of the world. And so all the capital will flow there. So if I can put this all into context, second half of the year there's more problems ahead. Time to move from the buy and hold to more actively managing your investments. Get Paul Towson or Vantage Advisory to help you look at your portfolio. This is the last chance to review before things turn down, and this is an important time to cash up. And those with the cash, those with the cash flow, and those with the available credit will make most of the money when assets are at bargain prices over the next few years. So in summary, we're in a new era where the debt super cycle is over. We'll go into a global, long, slow, painful reduction of credit, and that deleveraging is going to underperform the growth of certain economies, and that's naturally going to be a big plus for Asia and the emerging economies. If you have any questions, there'll be an opportunity below to send that through. We'll answer them for free. If you'd like to forward this to a friend, that would be fantastic for all parties concerned. If you would like to review your share portfolio, contact Vantage Advisory and I'll get Paul Towson to help you look at that. If you'd like to look at asset allocation for your own investments, what to do with your shares, what to do with residential property, what to do with whatever you currently have invested, this is a great time to do it. We are in very uncertain times. There's a lot of manipulation from governments trying to keep the music playing. And as I said at the start, the media are doing a great job in keeping the story going for the people who make the most out of the investment world, the institutions. Things are dynamic, and everything we talk about today may not be exactly as planned tomorrow. So keep in tune, keep in touch, stay tuned to Vantage Advisory. We're one of the few and independently owned and objective advisors in Australia, and I believe we're on the right path to help you build your wealth. There'll be some great opportunities in the next few years, but beware of the buy and hold strategy. This won't work moving forward.